The provincial government are really trying to push supplies. They have some pretty aggressive targets on building, especially missing middle type housing. And then you have municipalities who are putting huge development fees on that very housing.
Welcome to The Flow, Real Estate and Money Show, a show focused on helping Canadians understand the different elements of real estate, mortgage, and finance. The goal of our show is to provide Canadians with the tools, information, and knowledge to have more success when it comes to their investing and real estate related decisions going forward. My name is Alex McFadyen, and I'm your host. I can't wait to get you into the flow.
All right, welcome to the show, Mr. Brendon Ogmundson. Excited to have you on. Thanks for taking the time to make this happen. At this point, I'm going to go out and argue that anybody who's paid attention to a real estate podcast in the better part of the last, Canadian real estate podcast in the better part of the last 12 months has probably heard or seen your name somewhere because you're making the rounds. You've got lots of good stuff to say. And I learned that you are a bigger baseball fan than a hockey fan, and not American, which is crazy. But the listeners of the show who are from the West Coast will probably be excited that you're a Seahawks fan, right?
Oh yeah, major Seahawks fan. Training camp underway right now, so very, very exciting. New coach, new offense. Looking forward to it.
Yeah. There's like some big expectations right now, although we still have the same quarterback, so I'm not sure how I feel about that. But
you're not in the Geno hive.
No, I'm not. I'm not high on him per se. Not that. Yeah. But you know, what do I know? Nothing. I'm a hockey fan, so
he's got a low ceiling, but he's good enough for now.
Gets the job done. So how are we feeling about this year?
I'm excited to see something new. Very, very frustrating. All of Seattle sports is extremely frustrating. They seem to have a very hard time to putting like an entertaining product on the field. Like the Mariners right now have a historically bad offense. They can't score runs. It's really frustrating to watch because they've got also like a historically good pitching staff. So they should be way better than they are. They keep losing to terrible teams. It's very frustrating.
Yeah, and they don't want to do what they have to do right now, which is to actually make a trade to better their team because they think it's too expensive, but that's just the cost of the market, right?
Well, they have an extremely cheap owner who everyone hates. Like I was at Felix Hernandez's Mariner Hall of Fame induction and Ichiro's, I think, his Hall of Fame induction at Safeco, and they as soon as they bring out the owner, the whole place just boos him. So take the hint, man. Like either get rid of the team or like start spending money.
So that's a perfect segue into Canadian real estate, isn't it? I feel like it is. You could pick which figurehead you want to put where, but I feel like that segues right into where we're at right now, which is very interesting. A lot of new stuff happening this year. It was a lot of stuff happening last year, but definitely a lot going on this year. There's a lot of people that hate the current quote unquote head of our country. And probably, unfortunately, a lot of people who also hate the guy who's making the decisions, Mr. Macklem, over there. But there's just certainly a lot happening on, economically speaking, nationwide and BC-wide. Now, I know that you focus, so for those who haven't heard the intro, Mr. Brendon Ogmundson is the Chief Economist for the BC Real Estate Association. So you focus probably a lot of your attention, obviously, provincially speaking. But I know you obviously take a broader view. So I got to ask you the question. I totally cut you off. Oh my gosh. Go ahead to it.
I was going to say, I mean, obviously, a lot of the national economic trends and rates are national, and those affect a lot of what happens in the BC market. So we pay a lot of attention to the Canadian economic trends and U.S. economic trends as well.
So you're well versed in what's happening nationally, internationally, at least BC and Canada and the United States, because it has a direct impact.
Yeah, I think you have to. I'm a contributor to the Philadelphia Federal Reserve's survey of professional forecasters. I think it's the oldest survey of forecasters in North America. So I make a U.S. forecast every quarter, and that helps me stay on top of everything that's going on in the U.S. economy and global economy as well.
Okay. Well, I have to ask you this question because we talked about change in the Seahawks this year and having a big year. So we're mid-2024. What I'd be curious to know for you before we get started into some of the deeper questions is, what is the biggest change or surprise that you've seen from our at least our policy this year? Not real estate, but the policy this year. Any surprises, anything that you've seen?
I think it's kind of going according to forecast. The start of this year, we had 4 rate cuts penciled in for the Bank of Canada. We're well on our way to getting there. Maybe we'll get one extra. Depends on what they decide to do over the next few meetings. I thought the Fed would be cutting a bit earlier than maybe they're on tap for September. I think you could argue that they could have gone earlier, given some of the headwinds in that economy. But Most of it's gone according to how we thought. Sales are a little bit weaker than I thought they'd be. I thought we'd have a stronger response to a pretty big decline in 5-year fixed rates, but that hasn't seemed to have stimulated the market very much. And I guess prices are a bit higher than I thought they would be. We were in June, May or June, we were in Vancouver back to a little bit above all-time peak average prices, which is surprising considering the rate environment. So a couple of surprises, but generally things have gone according to how we thought they would go.
How boring.
It's so good though. I've been wanting a boring year for such a long time. We haven't had like a really boring year. I've been doing this since 2010. Not a lot of boring years in that 14 years. We've had, at that time we were recovering from a financial crisis. We had a massive oil shock. We had all kinds of different policies, foreign buyers taxes, the stress test. I don't know if you remember, we had a global pandemic. I mean, it hasn't been boring at all. So I'll take boring for a year. That's fine.
Well, so that's an interesting point to bring up. So the year has gone as predicted, but sitting in the depth of it day to day, as you are and I am in different parts of the industry, what's been interesting to note is, okay, so we had all these predictions at the start of the year, from yourself included, everyone, of course, suggesting that, the Bank of Canada was going to lower rates throughout the course of the year. We saw most reports were around anywhere between 0.75 to 1.25% was kind of what we saw everywhere as far as rates coming down through the year. So far, we're halfway in. We just had our second rate cut occur. And so it looks like we're on track for those numbers right now, but it hasn't necessarily happened exactly the way that we were thinking. As you mentioned, house prices have held pretty, aside from a pretty quick rush, we also saw them come back down, but they've held pretty steady. But also, something that I've noticed, and this is even something that even Tiff Macklem brought up in the recent announcement for the Bank of Canada, is that it's just been, every decision has been taken on its own. So I felt like a month ago, we were like, no, we're not going to see rate drops in July, no chance. And then 2 weeks later, data comes out and boom, we're having it happen. So it's just like, it's happening in the way that it was planned, in the sense that we saw rates coming down, but maybe not in that kind of smooth way down. It's been kind of an odd, rocky ride. Would you agree with that? Or what have you seen differently from your perspective?
I think if you look at like market expectations, like probabilities, they've been all over the place in between.
Right.
I think if you just look at the data and probably look at what the Bank of Canada is seeing as like a counterfactual. So right now, my guess is the Bank of Canada has their baseline projection, that incorporates what they're going to do with interest rates, and they have a counterfactual where they have a slightly more hawkish stance, but they go slower. We have models with very similar structure to the Bank of Canada's. When we run those type of counterfactuals, they show that if the Bank of Canada kept rates higher for longer, we would get a real undershoot of inflation. So we'd end up with inflation hitting about 1%. And we'd have at the cost of much higher unemployment and job losses, which is, I think, is what they're seeing. You even saw that Tiff Macklem in the press conference mentioning that there's a danger that inflation is actually too low going forward. So they actually had a really dovish statement today. So I think if you followed what would a model say is the right trajectory for rates, it's been on that very smooth path. What the bank is sort of doing is checking in each month, or when they have set, like, are rates following the expected path, is inflation following the expected path that's in our models, that's guiding our policy, and with a couple bumps, it is. So we're on a downward trajectory to the 2% target. And you have to remember, the Bank of Canada sets policy based on what they expect or what they want like 12 to 18 months from now. They're not setting it in hindsight. So each month of inflation data is telling them, are we on the expected path, right? So like, is this fitting what our models are saying, where we should be in the path that we're on, to get to target the next, say, 12 months, 12 to 18 months. And as long as inflation continues to confirm that we're on that path, they're going to keep cutting until they get to their kind of midpoint of their neutral rate, 2.75%.
So there's many out there that I've spoken to, actually, in the industry and outside of the direct lending industry, who are suggesting that the Bank of Canada is behind. Like, they should have been lowering rates earlier. The data is only just starting to come in right now. But to your point, they're suggesting, well, the data is delayed. One of the biggest arguments is that a large portion of the CPI is made of interest and shelter costs, and that the reason that we're facing this battle is self-created, and that they should have started reducing interest rates. So first of all, what are your thoughts on that?
I'm sympathetic to that argument, especially the idea that right now, not always, you don't want to, as a policymaker, be making special cases all of the time. Like, you want to have credibility. and predictability in what you're going to do. So I'm not a huge fan of necessarily the Bank of Canada like cherry picking data to justify a policy stance. But in this case, when you have CPI X shelter, so both rental and ownership costs, well below 2%, especially like a 3-month annualized basis, like on a momentum basis, really, really low, and basically at or below target for several months, you can make the case that rates should be coming down a little bit faster. I think you can make a case for excluding shelter costs right now because shelter's rising for reasons that are totally outside of the control or are being directly controlled or pushed forward ahead by the Bank of Canada. So on the rental side, if rates are high, it's very difficult for developers to get new products to the market or to start new projects, to get new rentals to the market. And then on the policy side, there's nothing to do with the Bank of Canada. We have really, really high immigration numbers that are pushing demand, and that's really pushing up rents. So rents are rising, but not because of necessarily because of monetary policy. And then on the ownership side, of course, when the Bank of Canada raises rates, so there's expectations they're going to raise rates. That pushes mortgage costs higher, so they're sort of feeding inflation with their own policy, and sometimes we'll get that offset by a decline in home prices. That hasn't happened this year or this cycle. So, if we were in a situation where inflation was like demand was really high because rates were being set too low, then yeah, you can't ignore shelter costs. But that's not the situation we're in. We're in a situation where shelter costs are rising almost exclusively because of supply side issues or policy issues that are either outside of the bank's control or that they're directly feeding through higher rates. So really good case, I think, to look through shelter costs when setting policy right now.
Okay, so we talked about policy, obviously setting the rates and so forth. I'm talking about different types of quote unquote policy. I'm gonna start to touch on the federal and the provincial changes that have occurred in the last 12 months. So you said that earlier in our conversation, you said that Vancouver prices, or at least I don't know if you're using benchmark or average, but prices in general have even risen slightly year over year compared to what they were before. Is that right?
Yeah, so I think it was in June we actually had, I think the average price in Vancouver was 1.35, which is was an all-time high, or matching the previous all-time high set in February of 2022 at the height of the market. So in Vancouver, prices didn't come down very much once the Bank of Canada started raising rates, and they're back to essentially where they were. That's not the case in every market. There's still markets like the Fraser Valley where prices got beat up a lot by high rates, and they've come back, but not maybe halfway from where they've fallen from since 2022. But generally, what we're seeing is that prices across BC have been basically flat for like 6 to 8 months. So kind of up year over year, but pretty much flat month over month.
Right. And, based on the fact that fixed interest rates have come down like 1.25% or 1.5% since like last year, this time, or somewhere in the 1% range, people can qualify for more than they would have then. And then we've also seen some positivity around variable rates, which is mostly going to impact people who are the homeowners. Would it be fair to suggest that there's a decent possibility that we're getting close to some form of a bottom or an artificial bottom based on what you're seeing right now? Or what are your thoughts on that?
Yeah, I think so. Really, since the bank raised rates in June and July of last year, we saw, we were actually in a kind of a normal market then. Sales were right back to historical averages. We're in a pretty good place. Bank of Canada raised rates, and we fell off again to about 20-25% below kind of normal, historically average levels. And that's kind of where we've been most of this year. Now that they've undone those 2 rate hikes that they put in place last year, I would expect we'll see sales pick up a bit. Like you said, a little bit easier to qualify. If you can get a 5-year fixed rate at 4.8 or maybe a little bit less than that, you're still qualifying at 6.8. Not awesome, but it's better than qualifying over 8% like it was last year. So that gives a little bit of room for some buyers to maybe come off the sideline. There's a lot more inventory now than there was this time last year too. So a lot more choice for buyers that are really interested in getting into the market. So I would expect we'll see some things really, I wouldn't say really pick up, but at least kind of get a little bit back to normal by the end of this year.
Right. Well, so where I was leading before, and maybe not leading, but what I was going to ask you is, because we talk about the government policy, obviously BOC, and the control they have over the rate market and the impact on, in this case, rental rates and to a degree or a lesser degree, house prices and shelter costs. Well, I guess not lesser degree. There have been a lot of changes in the last 12 months, like a lot. whether it be, obviously increasing rates, whether it be new taxes, new guidelines, the government coming out with, BC, I should say, coming out with new rules around land use and building. It's just been like a melting pot of like one thing after another, after another, after another, and after another. And what I think, I know it could be wrong here, but I think the intended idea here was to reduce the potential cost to the end user, so the home buyer, or at least make it more accessible, but at the same time try to keep prices relatively close to the same so they didn't destroy the homeowner. Am I wrong in assuming that was what appears to be the intended cost, or what are your thoughts there, or intended outcome?
So I think often this isn't super well coordinated policy-wise. So you see like the provincial government with their Homes for People plan are really trying to push supplies. They have some pretty aggressive targets on building, especially missing middle type housing. And then you have like municipalities who are putting huge development fees on that very housing. Like I think almost all of Metro Vancouver voted in. I don't know if it was doubling, but it was a very large increase in development fees. So where it used to cost $8,000 per door for new development, now it's like $20,000, or it's going to be after 3 years, going to phase in like $20,000 per door. And they also shift who pays that. It used to be that half of it would be covered by development, and half would be covered by the city budget. So sort of half old development, half new development. They're trying to shift all of that now. I think it's like 99% new development, 1% city budget. So not only are the fees going up, they're like all hitting the sort of pro formas of developers. So obviously, if you're going to make things a lot more expensive, it's going to make it a lot more difficult to build. On top of that, a lot of cities, or I think it's usually municipalities, are adding like affordable housing, sort of a inclusionary zoning, where you need, I think at one point, one of the projects was like 30% of a building, which effectively means the building's not going to be built. There's some really good research out of UCLA where they simulated a bunch of this and collected a bunch of data and found like once you get past about 20% inclusionary zoning, it's totally counterproductive, and you start losing housing supply. And so that's kind of the benchmark for as high as you can go on like how much affordable housing you can force into a project. Leaving aside a very good question, I think Tom Davidoff brought this up the first time. Like, I'm not really sure why we kind of make new housing the most expensive type of housing be affordable housing, instead of just building a lot of housing and letting it filter into the resale stock and open up the resale stock that's more affordable. It seems like a better approach, but we decided to go this route instead. We'll see how productive it is.
So basically, like, there was a lot to unpack there. So many key points that you touched on, and I'm trying to circle back to the beginning of that, of all the comments that you made there. But there's some people listening to this audio or watching the YouTube video that might not know about all the changes that have occurred in the last, 6-12 months. And specifically, some of the ones you're talking about are based on the requirements for building efforts. So essentially, without going too deep into it, there is a requirement such that you have to have, in your case, 1/3 or 30% of a building below. Can you maybe define that specifically?
For some projects, they're really big, and that's like just kind of a side show. The big things are really that they're not completely doing away with single family zoning, but they're allowing for small scale multiplexes on single family lots. So you could take a single family home and put, I think, 4 to 6 units on that lot. They've mandated that around transit hubs, you're supposed to have a minimum, I think it was, up to like 20 stories close to SkyTrain. So huge increase. Yeah.
The cities have to agree to this too, as well.
The cities have to do, I believe what the law is, the legislation that they're looking at is the cities have to do at least as good as what the province is legislating. But then they're allowed to throw in other covenants, and they're massively increased development fees. So at the end of the day, the developers are going to have to make sense for them to build, right? Like, private sector builds like 98% of housing. So the conditions have to be there for developers to build. If we have the zoning, that's great. We have all these policies in place. It's a really good incentive. At the end of the day, we need the sort of interest rates, the market conditions, everything else, the environment, materials, everything else to actually in those
get them to build. We need more housing. Yeah. So based on what you're talking about right now, and what and what you've seen, and the people that you're hearing from right now, I don't know if you're talking to any developers or if you're just kind of hearing from people in the field, but like, what type of feedback are you hearing from those who are or were building? Are they waiting? Are they buying land? Are they even going through the development process? Are they, what's going on there? Because I mean, obviously, on one hand, we're seeing, I'm located in the Fraser Valley, and I'm seeing building go up all over the place. But on the other hand, we're seeing articles in some of them, provincially or locally, and some of them more nationally about, foreclosures left, right, and center, and empty buildings, and all these types of things. So it's kind of conflicting with one another. We need the demand, we need the building, we need to build, yet there's stuff empty. What's going on there?
So yeah, new housing, of course, runs on pre-sales. So if the pre-sale market's soft, you're not going to be able to finance a lot of that new development. So a lot of it starts with market conditions. Some of the smaller developers and even some of the larger developers have run into some real financial trouble getting some of those buildings, and they've had to actually give up the sites and give up on those projects. And then you've got other really successful projects, especially the First Nations projects, which are, I walked by the Sanok development over on Burrard, across the Burrard Street Bridge the other day, and it's gone up so fast, like compared to the molasses pace of development usually. Like that project went from kind of conception to permitted and built, already like well underway in a very short period of time, because they didn't have to abide by a lot of municipal permitting and regulations. It's their land, and they got it done very, very quickly. So
the building requirements, safety and
yeah,
quality build, that all to be the same.
Yeah,
no
but
changes there.
But the speed of permitting and that kind of thing seems to be, for whatever reason, they were able to bypass a lot of the usual kind of bureaucracy.
Okay, so this is like the perfect study. We've got a property in Vancouver, a building in Vancouver that's going up. What would you say? Twice as fast, 3 times as fast, 4 times? Like how much quicker are we talking here?
Much faster, especially for its size. I think they're planning 6,000 units. It's a huge development, and for it to be able to get underway that quickly is really impressive.
Right. Okay. And yet we have vacant land foreclosures going out all across BC, specifically the Lower Mainland, Fraser Valley, because as you mentioned here, a variety of items around bureaucracy. So on one hand, we need to build. On the other hand, we're charging more money, and we've got, okay, so this is fun. Awesome. Good to know. Thank you for clarifying that for everyone here. So now you've got the master plan, right? So what's the solution?
Well, obviously, what the province really wants at the end of the day is to build a lot more housing. So we've been doing some research into exactly how that gets done. We're not experts in the construction process. We're not looking at it from like a pro forma kind of way. We're thinking it more kind of a top-down macro kind of way. So big picture, you need 2 major inputs, labor and capital. So you need people to build stuff. If you're going to build an apartment building, you probably need cranes and other equipment. So that's like the capital you need to invest. And then you need like the sort of magic of like marrying capital and labor and technology. And that's sort of what we call multi-factor productivity. What we really need to hit the targets the province wants to hit, which is about 250,000 units over and above some baseline. I'm not really sure what their baseline was. Let's just call it like a total of about 600,000 units. It's probably not going to be enough to just throw bodies at that problem. Like we probably can't hire, enough construction workers, and just throw people at this problem to get those buildings built. In our models, we assume that we have a similar increase in construction employment that New Zealand saw when they did a massive rezoning. They increased the employment share in construction from 6% to 8.5% or something. So we had something similar magnitude. We have about 130,000 new construction workers in BC. The problem is that about 20% of the construction workforce is over 55, which is a problem if you want to build a lot of housing in the next 10 years when your most experienced, most productive workers are all leaving the workforce. So when you look at the BC government's labor market outlook, they're only expecting about a 12,000 person increase in the construction sector in employment, about 66,000 openings, but almost all of those are backfilling for retirements. So we need to kind of backfill plus add about 130,000 more. So it's a lot. Obviously, that's going to have to come through, either taking demand from other sectors, people changing jobs or switching from mainly working in non-residential kind of stuff into residential. we got to train a lot more young people. We got to convince a lot more young people to get into trades and get them trained very quickly. Or we need to have really targeted immigration, but that also comes with a housing demand aspect. And there's a possibility that that could be counterproductive in the short run, because you bring in one person with their family, they can't build 3 homes, right? They right, to satisfy that demand. So,
this leads me to the question around that, which is like, we just brought in a whole lot of humans to our country, and it's, I mean, obviously we've got other sectors besides building that require, expertise and talent and so forth. But I mean, I think anybody could recognize what you're saying right now, and anybody in the industry in particular, especially over the last 5 years, could easily point out and say, yeah, we have a large shortage of skilled trades, and it's obviously a high in demand series of fields. Like, we've seen this coming. It's not, on the sidelines, I can tell you that I've seen that, right? So, like, at this point right now, is there anything set up right now to target these types of people? Is this something that they've thought about or considered doing? Because it kind of blows my mind. And I have no problem with people immigrating to the country. I have no problem with people coming here. But it seems like we have a lot of people who don't really have any real skills or aren't really doing anything. And it seems kind of odd that we haven't targeted that.
I don't think it's been well targeted at construction. I think that unlike the United States, I think like the new immigrant workforce is a smaller share of the construction sector than it is in the United States, where they have a very high share of immigrant workers in construction. I think in Canada it's actually kind of low. So maybe we haven't done such a good job of targeting, but certainly, if we're going to be hiring, and like if you just say status quo, like if we're only going to add 12,000 new jobs to construction, we don't need to target that through immigration. But if we need to massively expand the construction workforce, then it's going to be hard to do without some targeted immigration. So, the baseline case, we could get by without doing that, but to really expand the productive capacity of the sector, we're going to need a lot more workers, and in a pretty short order. It's hard to train that many young people in that period of time. So,
okay.
The other aspect is that just like, using technology, maybe we can use emerging AI technologies to really speed up permitting. Have a computer go through these designs, and if it fits the template, good. You get that done very quickly. Any kind of emerging technology with offsite construction, people get I know there's a lot of very large barriers and roadblocks to doing modular housing and factory built housing, and taking building the components offsite and bringing them to site, but we got to do something to speed up that process, so that not only are we throwing bodies to the problem, but we're just doing it a lot smarter and a lot faster.
Yeah, no, fair points. I'm going to shift gears a little bit here. Just, there's a few key things that I know a lot of people want to know, kind of looking into the second half of this year. So based on the rate, the Bank of Canada's rate decision dropping us now 50 points, prime sitting at 6.7, or it will be very soon at most banks and lenders, probably stimulating a little bit more positivity in the marketplace. We obviously know about the challenges related to building. We're struggling. It's not happening. And there's not going along right now. In the beginning of the year, I listened to one of the podcasts that you did with our friends over at Vancouver Real Estate Podcast, and you talked a little bit about value and where market value could go. And obviously this is just general predictions and not like foresight per se. But looking at where the market is right now, based on your understanding of what you just shared with me right now, what I'd love to know, I know what the listeners would like to know, is where do you see today, and I'll use the word value, you can define it as whatever you'd like, value in the marketplace based on where things could go in the next 2 to 5 years? Where are you seeing, hey, this area of the market seems to be soft, but it doesn't seem like there's any real reason why it would continue to be this way relative to where it is, where it's going?
Yeah, it's a good question. So like, I think whenever, our friends, the Scalinas, always ask me about this, I always talk about the Fraser Valley, because the growth in Surrey is incredible, and it's going to be a larger city than Vancouver in short order. I put together an animation a while ago of a timeline from 2020 to now of population growth across Metro Vancouver, and actually across all major cities in the province. And just watching the Surrey bar catch up to Vancouver is amazing. So I would always be bullish on Surrey, because it's so big. There's a lot of places to develop still, and its population is super young, and it's a huge population. So that's always one. I know prices in the Fraser Valley have been pretty flat this year, but long term, I think it's hard. I'd always bet on population growth. The other ones I always talk about are like the Kootenays, where prices have grown a lot lately. some issues there, especially for retirees. It's kind of a bit of a healthcare desert, so it's maybe not the optimal place but you can get it's like waterfront property for under $1 million in a lot of the Kootenay. It's gorgeous, it's diverse. So that's another market where prices have been really rising. Other places that are I always find are sort of like a domino effect from Kelowna. So Kelowna got really big and really expensive, but retirees still really like the Okanagan. So for a while, Penticton might have been the next closest kind of destination. It got pretty expensive. Kamloops got pretty expensive, and Kamloops is growing really fast, one of the 5 fastest growing cities in Canada. So those markets, maybe they've a lot of what's happened kind of happened very fast, where those markets saw a decade's worth of price appreciation in a really short period of time. But even markets in the north, I think are still, if you're more looking investor, those are places that are still maybe growing a bit. Around Prince George, especially because it has a hospital, has a med school, it's a place where healthcare is a little more direct than some other markets.
And then conversely speaking, are there any markets that you're aware of right now that would be, what's the word I'm trying to think about here? Maybe you don't see much price appreciation for the foreseeable future. Maybe an area that just got way overheated, that's just stuck and probably going to take a long time to recover.
Yeah, I think, Vancouver is one of those places where prices are just flat. And at, it's always going to have its luxury market. Condos are very expensive. We've really, as policymakers, really messed up when entry level product in our largest city in the province is $800,000. So the average price for an apartment in Vancouver, ex Surrey and Langley, so I'm talking the greater Vancouver realtor area, which isn't Metro Vancouver, it's always confusing to everybody, it's $830,000. And that's a really bad place to be if you're talking about an apartment price, right? And so what should be an entry level first time buyer product is very expensive.
Interesting.
I don't know if there's a lot of room for prices to grow in probably would have said that maybe about Vancouver 5 years ago, but it was kind of surprising. But prices are very high. I don't see them going down, but as far as are you going to get a lot of price appreciation in that market? I think it's pretty indicative of what we saw in the pandemic, where other markets went up 60% and Vancouver went up 15 or 20, whatever it was. So obviously there's a jump, but not compared to other places. So
the minimum bar is kind of held pretty high right now.
There's only so much room, and just looking at affordability calculations, it's only so much room for prices to go before you're pricing out 90% of the population. So I would guess, Vancouver's certainly enjoyed a lot of price appreciation. I would be surprised if it got more than inflation level price increases for a while.
Got it.
Because its prices got so high.
Okay, because we're zigzagging. We're going to keep zigging and zagging and ripping through here. So again, we talked about what the BOC's done. Everybody likes talking about that. Why not? I would love to know what your projection, and this is obviously something that's going to either look really awesome or not, for your sake. But what are you suggesting might happen for the second half of 2020 from the BOC?
No one ever remembers bad forecasts, but if you make one really good one, you can make a career out of it. So what the incentive is to just make really bold predictions all the time. If one of them you get right, then your career is made. I haven't totally learned that lesson, so I'm usually pretty boring. I expect 2 more rate cuts this year, like everyone else. So I expect we get to 4% by the end of this year. Possibly we get to 3.75. Possibly we're at 4.25. But I don't think they're certainly not done. I feel like they read their statement today. They were very dovish. Didn't signal that they thought they were close to done. The inflation, as long as inflation's on the path they think it's going to be, there's no reason for them not to bring rates back to neutral, especially given the weakness in the economy. Our forecast looks a lot like theirs. So we're at 1% growth this year. I think they're at 1.2. We're at 2.2 next year. They're at 2.4. So our forecast for growth looks a lot like theirs. Our forecast for inflation looks, I think we're a little bit under. I think we're at 2% a little before they get there. But that just calls for rates to continue coming down until we hit neutral. And if that's 2.75, then that's where they'll stop. I know there's a really good David Rosenberg article today in the Globe and Mail arguing for rates to fall all the way to 1.75. But to get there, you would have to be very bearish on the Canadian economy. And that's, his his whole thing is being very bearish, and he thinks we're kind of in a recession now or about to enter one. So if that's the case, yeah, rates will go below neutral. But I think a pretty good forecast for now is we'll get to 275 sometime in 2025, and probably won't stay there very long because the economy is almost never at our rates are almost never at their neutral level for very long. So I'm sure something will come along that pushes us higher or lower.
Nervous to see what that might be. And to your point, I guess he's shooting his shot on this wild prediction today. So interesting to hear. I'll have to scope that one out as best I can to have a look and see what's going on there. Okay. And then I guess my last quick question for you is like kind of looking for the second half of 2024. We talked about a couple policies. We didn't get into obviously what's happening on the rental side of things and so forth, but like out of the policies that you've seen, both federal and provincial, which one do you think is going to have the biggest impact on the housing market going into the second half of this year? Any tax change, any policy change, what do you think is going to have the biggest impact, both positive or negative, going into the second half of this year?
I think most of the most impactful policies are all long term, so probably not second half of this year. I guess even like the flipping tax doesn't actually come in until next year. Is that right?
January of next year. Yep.
I don't think that to have much of an impact either. We're going to start ramping down non-permanent residents in the next year or 2-3 years. That'll have a really big impact in the rental market for sure, because it means like a pretty large net outflow of like 200,000 people a year. So I would expect that's going to have a big impact. Will actually help a lot with the rental inflation, part of the inflation problem. What else are we doing? I mean, I guess we have a provincial election in October. That could be interesting. But other than that, like it's all about monetary policy. So and again, like pretty boring forecast that they keep cutting.
Hey, it is what it is. So we know where it's going to go. So TIP's going to be controlling where things go in the housing market for the better part of the next 6 to 12 months. And it's going to be either really boring or absolutely mind-blowing and exciting. One or the other, right?
I don't think it'll be exciting for sure, but I think it'll be like either mildly boring or like disappointingly boring if sales don't pick up at all.
Honestly, I feel like most people will be okay with that because it creates a comfort level and at least a smooth downward cycle, which people I think are hoping for right now.
We could get to a point where sales are just kind of normal and we have plentiful inventory and all is right with the world, and Canadians fans are having a beer with Maple Leafs fans and everything's great, and that sounds like a pretty good world, right?
He's living in the Twilight Zone. Awesome. Brendon, thank you so much, man. I really appreciate you and your time, and I know our listeners do. Thanks for hopping on the show, man. And I will make sure to put all your information down in the show notes so people can tweet you or DM you or whatever you like to receive, or you can block everybody and say, I'll see you on the next time. So thank you for joining us, brother. Appreciate it very much.
Thank you.
That was an unreal episode of The Flow. I hope you enjoyed it as much as I did on my side right here. If you haven't already done so, make sure to check out all of the incredible resources that we have available. You can find us on Instagram at Flow Mortgage Co. You can find us on our website, getflowmortgage.ca. And of course, don't forget our free first-time homebuyer masterclass that's currently available on our website for anyone who listens to the episodes. And if you loved what you listened here today, the only thing that we ask for is to share this with someone else that you think this could help. And hey, maybe leave us a great review online.